Okay, routine. Now, fear not, this is not going to be an exercise of me telling you what time to go to bed and what time to wake up, what time to be in the office and what time to leave. This is about developing a routine that works for you. And one of the key bits to a routine is having individual routines for different elements of your day. So we're going to go and explore that, different ways to approach things, but this will bring in an element of a very clear structure around preparation, around how you mentally prepare at the beginning of the day, and also a very clear structure around how you decide when and whether to take a trade on. So, routine. The whole point of having a routine is to make sure that in an environment of major uncertainty, let's face it, that's what trading is. You are approaching a completely new thing every single day. There are some things that you can control, and your routine is one of the things that you can control. So controlling the controllables means that you can at least then adapt and grow. That's the crucial aspect of it. So consistency really matters with a routine. Again, this is not about what time you do things. It's not a time-based routine. The consistency is in the consistent questions that you ask, the way that you consider what is going on. Because if you do this in a consistent way, it makes it very easy to define whether there are bits that need to be tweaked, whether there is more information that you may well need to find, which will then lead into your debrief. So that's the first thing, consistency matters. The other thing with consistency is that one, it becomes habitualized, and two, it creates the right type of mindset. If you come into the day and consistently you are ready in the same way that you always are, you immediately feel ready to trade. There's not a murkiness of, well, there's other things going on and you may not have ticked all the boxes, you may not have done your preparation in full in the way that you would want to. By having that consistency in the way that you do things and a clear process to do it means that you don't miss anything. And it means that you go into the trading day completely ready to get on with the job at hand, which is to do some trading. The next thing is to have a routine or a process to assimilate information. This is about how you gather information, how you decide what is important, what is going to generate a trade idea, and what is merely useful information that bubbles along in the, in the ether. It's useful, it improves your knowledge overall. But there are some things that are pertinent. These are going to matter today. These are going to be opportunities. Now, this, when we come to it, in terms of pricing in information, is about understanding whether that news is something that the market already has and that has been absorbed and that is it, or whether this is an ongoing story. So assimilating information and understanding what that means for your next opportunity. This does relate back, and a lot of the routine stuff we're going to use as a way to pull in some of the things that we've talked about already. Think back to sort of crisis trading and the idea of building narrative. Once it comes down to the actual trading, if you have assimilated the available news information, if you have consistently asked yourself what is potential and what markets could do today, then it becomes much easier to manage expectations. Not every day is going to trade the same. So if you can manage your expectations and know where the possibilities are for the day, then you put yourself into a position where you can legitimately look at a trade and say, that is enough. I don't think there's going to be any more. And you can confidently say, I think there's those number of ticks and that is it for today. Whereas there are going to be other days where you can look at what's going on and say to yourself, you know what, there is more. There is scope in this. Think back to the idea of the different quality trades when we talked about risk management with the IB breaks and the difference in terms of the scope and context that enables a bigger potential move. What it also does is allows you to structure larger time frame trades. By consistently prepping in the same way, by having this consistent routine, these trades are going to become more clear. It may mean that this is a trade that is developing over time, that 5 days down the line, the opportunity now appears. It doesn't mean that you're always going to be structuring this one bigger, larger time frame trade, but it means that you've got the build up of information, the story, so that when that bigger opportunity comes, you're aware of it and you're ready for it. And finally, it provides you with a benchmark. It allows you to assess what you've done on the day with reference to how you prepared, what you did, how you planned your day out, so you can see where improvements can be made immediately. And by having a consistent benchmark, then you also can recognize when you're not achieving that. The point here is that when you get into tougher times, everybody will experience this and everyone will go through periods where markets are not conducive to your style, to your profitability. Then you're able to fall back to your kind of benchmark base level, and you know that you can at least achieve certain things. And by having that, it means that you can ride out some of the tougher periods. Yes, you may not get exceptional growth. Yes, you may even be flat. But what it will mean is that you're not getting punished by those harder periods, and meaning that you're able, or more able, to come out of them and grow from there. So routine is really, really valuable. And making sure that you are, and remember it always, control the controllables. You can't control a lot of things in this game, but you can control the way you conduct yourself, what you do, and how you do it. What you're trying to do is you're trying to generate a feedback loop, essentially. Do you have your preparation? This tells you what you're going to do for the day. You're then going to have actionable trades. You know the opportunities that are there. You can wait for those trades to come up. You will get to take some of them. You will not get to take others. Take the trades on. This is the trading part of the day. Take your trades on. This will give you information. Whether you win or lose on your early trades, don't look at this as, oh no, it's not worked, I'm struggling. This gives you more information. The more information you have, the better decisions you can make going forward. The more information you have, the more detailed your debrief can be. By having a clear and detailed debrief, you give yourself a better understanding of what's just happened, which improves your preparation for the next day. And what it also does is makes your preparation much, much more efficient. This is why traders with a fair bit of experience who've done debriefs consistently, you have a consistent process to do their preparation, the consistent routine, can do preparation very quick. Very quickly, they can look at a market and not know, but have a very clear idea of what could be coming for the rest of the day, or what could be coming later on that day, what the scope is, simply because the debrief that they have done has provided so much information, the preparation becomes very, very easy. So you're trying to create this constant feedback loop. What it also helps you with is making sure that if there's things that could go into your preparation to improve it, to make your judgments of the following day better, then you can do that and you can bring those things in. So always think about feedback loop. Anything you do now is going to pay you in the future. And it's about generating that kind of growth, because over time, that will generate performance into the future. It's not about making sure that preparation done right now is always going to produce results. But what it is going to do is be able to be improved, enhance your routine and your overall preparation now, which will pay you and improve you as time goes by. Right then, to give a brief bit of structure to a narrative. This is an example of my trading day. When I lived in London, I can't cycle to work anymore, so I won't be cycling in. But I had this down almost to the minute on a lot of things. Now, this is useful because what it gives you is very clear structure as to what you should be doing and when. Now, the early part of the day, the getting up, getting to the office, having a shower and having breakfast, of course, that's a personal thing of how you do that. But for me, one of the important aspects of that was that by getting this very clear and very crisp, it solves, well, not solves problems, but it helps you in a couple of ways. One, you're not spending time thinking about what you're doing in the morning. You know exactly what you're going to do because there is consistency to it. Two, it gives an early sense of achievement for the day, that by having quite strict timelines to do these things, achieving it, for example, getting to work within a certain timeline on a bike, requires a bit of effort. And so this puts you in the right mindset immediately, that you're already in the mindset of achieving something. It's not a casual just wanderance to work. There's got to be some pace about it. That for me was important. It doesn't necessarily mean that for everybody you must do these types of things, but it's getting yourself into the right mindset, into that process, right. It's time to get some stuff done. Build your focus up. Next up, scanning news, planning opening trades. There are certain specific trades to be done immediately at the open. These are the trades that I'm going to concentrate on first. And for this, I'm looking at the Eurex 7 o'clock open. If you're in America, this might be for the NYSE open, for the oil open, any of these types of trades. It's very specific trades. Often, you wouldn't do anything, but you'd make that assessment very quickly on the basis of there are certain rule sets for these early trades. If nothing falls into place, you don't take it, you move on. It's onwards to now, defining opportunities for the day. Assessing the importance of news. What does this news mean for the rest of the day? What additional news do you have coming up for the day? So it's about then I'd have a daily sheet, and I'll share this with you in a bit, of information that I need to know for the rest of the day, so I can start to plan out and structure my day entirely. So once I've decided where the opportunities are, what the potential information is that I'm going to get, what news I've got to be aware of throughout the day, it's then time to gain some focus. Now I put get a coffee, that was important. That was part of, again, the ritual before starting to trade. Get a coffee, get a glass of water, and be ready. And so I would then spend a little bit of time before the open, so this is before the European cash open, a few minutes of not overthinking, not bringing in new ideas, not making judgments that change anything I've already done. You've done your prep. The process is in place. Then I'd sit back and say to myself, right, it's time to just focus now, calm your mind down and just sit and just watch. And that's all. So be about just getting into a zone of just focusing on what is going on. Not overthinking what you've already done. You've already planned these things out. Trust the plan, because the plan will come along at some point and you'll get to do these trades. You don't need to invent new ideas and you don't need to jump and become reactive. So it prevents reactive trading. Then it's down to trading. After that, once volatility starts dying down, I put 11 till 12. This is not absolute finite. If action is going on, you're going to keep trading it. But giving yourself a bit of time then to review what's happened so far for the day. Information you've gained, what the implication of this is. And I'll talk about this when we talk about assimilation of information. It's about how the market reacted relative to what you think it should have done. That's the information, not just information incoming. You know, you can have positive information for stocks, but if stocks don't go up on it, that's even bigger information. Rather than it's positive, therefore stocks should go up. Well, think about it in the other way. It's positive, stocks should go up and they haven't. This is telling you very clearly stocks want to go down. And then it's an update of your prep, an update of where we've got to, what's changed, what hypotheses are you perhaps very clearly falling into, and what markets are still open for interpretation. Where are your next opportunities for the afternoon? Before then, afternoon trading. So it gives you a clear break. It gives you that chance to step away from the actual action, refresh your mind. I would recommend taking a walk, take a bit of time out at this point. Again, physically refresh your mind, and we'll get onto that in a little while. Then afternoon trading, US data typically included in this as well, so make sure you give yourself time to prepare for the data. And then any trades on the European close, debrief, and then going home. So very, very clear. Now, this is useful because what it does is it provides structure, it compartmentalizes what is going on. That's great. What it doesn't do so well is it doesn't actually have any required elements. So what I mean by that is each of these things doesn't have a very clear process within it. So a much more refined, narrow process. What that means is then you can fall into a trap of basically your prep could be open a chart, look at it, jump to a conclusion, move on, prep done. Particularly if you're late to the office, something like that, you can rush through these things. The important thing is the sequence. It's going through these things in order, in sequence, making sure that you have ticked all the boxes off before you start trading, not about the timings. If you get to work late and you're there because the train strikes 5 minutes before the open, do your prep, forego some of that opening trade, because without the clear prep and the consistency behind it, you run the risk that what you're going to end up doing is jumping into things that are not very well thought out. That's the danger. So, good to have structure, good to have sequence. You need then detail within this, and it's the routine around each part of it that also matters. Right then, so what we're going to go and have a look at, preparation routines. How do you assess the opportunities out there? What questions are you asking of different timeframes? So it's going to be a walk through different timeframes. News. How do you understand what has been priced in and recognize what can change, where the next opportunity is? We'll look at trade execution. How you question your opportunity, how you decide whether this is the right trade to be doing now or not. Where is your access? That's what it comes down to. So we're looking at access a bit more. Economic data routine. We've looked at these already. So we won't spend a great deal of time on this, but it will just be a sense of you're bringing this back in so that you've got a clear process for how you go about doing this, and also for defining different routines or different structures around economic data. A mental routine. Different mechanisms to get yourself in the right mindset. And this is more a sense of giving people methods, ideas, rather than saying this is what you must do, because every trader comes in differently. For some people, their mental routine will be making sure that they have run to the office, done a lot of fitness beforehand. Others, it will be about coming in when they feel is right. Not rushing themselves in, because that way they come in not feeling that they are trying to make sure they're ticking boxes in terms of time, but they will still have a clear preparation. We're going to move on to debriefing in the next few days. So this won't be covered in detail here, but the important thing with any kind of debrief routine is that this has to constantly be evolving. Your debrief 5 years into your career is going to be very, very different from your debrief 5 weeks into your career, because of what you're trying to learn and how you're trying to improve the way that you go about your trading. Right then, first trades. This is about coming in, pre-open, what are the trades that you're first going to be taking? And this all comes down to your understanding of what has happened in what I would call the extended hours trading session or the overnight session. So it's your opening plays, basically, opening things to do. What you have to remember is that outside of the main cash hours, outside of the underlying product hours, moves are typically lower volume. Therefore, they are less reliable. Therefore, they could well be turned around. Now, this doesn't mean that they always will be, and it also doesn't mean that every slight move in an overnight session is insignificant. But it will provide certain specific opportunities that allow you to take trades on. Think back to the positioning trade from Profile Week. What you can also do is you can work out theoretical opening prices. I'll explain how to do this in a little while. What you have to think about here is that most markets, or certainly correlated markets, will trade with a spread. So think of T-notes against bunds. So German bonds versus US bonds. They are the same product. Excuse me. They are the same type of product, but with differing inputs relative to bond issuance and interest rates in the US versus Europe. So they will maintain a spread between the two. And without any distinct information that moves one of them independently of the other, that spread will maintain. This is useful information, because what you can do is you can use that spread to determine an opening price. Now, particularly for Europe, US markets trade much higher volume throughout the night. This is part of a legacy that US markets have done this for a lot longer than European markets, and they're the main markets that people will use to hedge positions. Bear in mind, a lot more trade is dollar denominated than any other currency denominated. So if you're going to hedge a position in the Asian session into any other futures market, you're going to go into US type products. Therefore, the movement in a T-note will be able to predict or create an expected opening price for the bund, the equivalent European bond. This gives you a trade opportunity. And you can do the same thing with equity markets. It's harder with commodities because most commodities are, one, traded 24/7, but there aren't sort of various equivalent commodity markets. So, equity and bond trade predominantly. What you're looking at, because the European bonds and equities will trade with the US ones until 9 o'clock at night. Still a lighter volume than when their main cash session is. What you can then look at is what the T-note does from there. This will allow you to define the opening prices for the bund, or use the S&P to determine opening prices for Euro stocks, or DAX, for example. So how do you do it? Well, you need to calculate a ratio. One way to do this is to divide their ATRs. So you take the ATR in the S&P and the ATR in Euro stocks, divide them, so you now have a ratio of if the S&P moves X number of ticks, and when I say ticks, big ticks, the Euro stocks should move the same. That maintains the ratio between the two. That allows you to then go, right, okay, the S&P is up 10 handles from 9 p.m. yesterday, Euro stocks should be up 10 ticks. If it is not, then there is a trade. It's basically an arbitrage trade playing one side of the move. That's one way to do it. The other way to do it is you could divide price by price. So let's say you're looking at the S&P and the DAX. Well, very simple ratio here. The S&P is around about a third of the DAX price, so you do a 3-to-1 ratio. Historically, there are some basic ratios that you can follow, because going into ratios, you're going to end up with very, very specific numbers that are constantly going to be changing. The rough rules that have been consistent for many years is that for the Bund, 1 tick move in the Bund for every half tick move in the T-note. So if the T-note moves a half tick overnight, the Bund should move 1 tick on the open, or should be 1 tick higher on the open. S&P, 1 handle in the S&P, 1 fat tick in the S&P is equal to 1 tick in the Euro stocks and approximately 4 ticks in the DAX. That's your general ratio. So this is one of the opening trades to be looking for beyond the positioning trades or any kind of gap trades that you might also be looking for. So factoring these things in. If you have a positioning move in the overnight session, so let's say you have a very light volume European positioning move, and also this is out of line with the T-note, all of a sudden you've now got a much stronger potential. So let's go and have a look at an example. It's always easier to explain these with more extreme examples, but you can look for this on a day-to-day basis. To use an extreme example, this was the move over Brexit. Now, at the time, Eurex did not have an overnight session. It shut at 9 o'clock. And then you get the gap up in the morning. On the Brexit decision, this is what the T-note does. The T-note rallies. In that overnight session, before the European equities open, the T-note is up 170 half ticks. Theoretically then, this should mean that the Bund is going to be up 170 half ticks. And the Bobble, because of the ratio Bund to Bobble, should be up half that. As a rough ratio, as you go down the durations, 10-year to 5-year to 2-year, the size of movement will halve. So 100 ticks in the Bund will be 50 ticks in the Bobble, will be 25 in the Schatz. That would be a rough equivalent. So, with the T-note up 170, the Bund should be up 170 as well, and the Bobble should be up 85. However, they're not. The Bund is up 470, and the Bobble is up 103. So I'll give you a chance to think about what to do here, and the clue is think about the news and the implication for bond markets. But what should the trade be in this situation, in the Bobble or the Bund or both? Pause it, have a little moment to think about that, and then I will explain. Right, so the trade is, on this one, that you want to be buying the Bobble. For a lot of traders, I know a lot of people took this trade, they bought the Bund. They got out very quick, took some profit out of this, but you did get a volatility stop and the Bund gapped back down 120 ticks. So if you did not get out, you got punished 120 ticks in the Bund on this trade, simply because it had gone too far. So, on this basis, you don't really want to sell the Bund because of the fact this is Brexit. There is very clear news which should be a buy for bonds. So you don't want to buy this in case there is a big stop and this runs 100 ticks to the upside and doesn't come back to a scratch. So you don't want to buy the Bund because it's too far. You don't really want to sell it in case it does explode further. The Bobble, yes, it is opening too high by only 18 ticks. So whilst against the T-note, the Bobble is too high, against the Bund, the Bobble is way lower than one would expect. If you're taking the move in the Bund, the Bobble should be up 235 ticks. So compared to the Bund, the Bobble is actually 132 ticks too low. So on that basis, the Bobble offers the trade here. Gives you the chance for the run up, and if you look at the equivalent move, the Bund skips and falls, and that falls just shy of 250 ticks. The Bobble jumps up, pulls back, goes higher. It's not a gigantic movement, but this is clean. And this is not going to put you under a huge amount of risk as the Bund did. It's about understanding what's driving the open and what is relatively too far and what is not. So that's how you want to be thinking about the open. That's an extreme case. In most cases, you're going to have a situation where there may well be an opportunity where maybe the Bund is 10 ticks out of line with the T-note. And that will be sufficient. You can play that back. You take those 10 ticks. That's your first trade of the day. Done. And it's about then just calculating where it should open and then looking at where it is opening. The benefit you have nowadays is that the European equities do trade in the overnight session. So this now, and the European bonds I should say, this now means that you have the opportunity to enter a trade possibly and get a slightly better position, slightly more variance away from where the market should be in order to play that at the 7 a.m. open. So that's one of the first things to be looking for. One of the other trades, of course, is the positioning trade. This is one in oil, and this is what I call an extended trade now as trap. So what you have here, and this is why it's so important when you're looking at markets coming into regular trading hours, cash sessions, to look at where the cash sessions have been recently. So what you have here is cash session sell-off. It's a light volume move, and that creates a sell-off down the range. It's not huge. It's not huge in terms of volatility. It's about 300 ticks. Overnight, then, so the extended trade now is we trade down, we trade back up. So pretty balanced. Arguably, we're a little bit of strength given to buyers, but on the whole, it's balanced. Coming into the next day, then, what you've essentially done is had a light volume sell-off followed by consolidation that has a slight bias towards the upside. This effectively is a trap. Everybody who's short in here is trapped. All that selling has taken place roughly below the low of the last 3 days. So when you come into the next day at the open, we open towards the top of the overnight range, but crucially, and this is why you need to check cash sessions against each other, you're opening well within the range of the previous cash session, well within value. And it's for that reason that this seeming weakness is not in any way as weak as one might have thought. It trades all the way down here throughout the night, so it continues down there. But the fact that it can't hold down here is now creating a trap of positioning, meaning that you have this reversal play. You don't have to take this straight off. I'm not saying that this is a trade that you just go, right, I've seen it, buy it on the break. This is a trade where you can wait for it to break the overnight high and play it, or you can wait for a pullback to play the move and play the move back up through value. But it's always about thinking, right, well, how have people got themselves positioned and where is their pain point on this type of trade? So they're always going to be my first trades. If there is a clear reason to try and play a reversal or play a gap continuation or a news-based overnight trade, great, you can play it. If not, you move straight on and you get into your morning preparation. Right then, technical preparation. This is exactly what you think it is. Looking through your charts to define where your opportunities lie, where you want to be involved, where you may get the chance to be involved, where markets can realistically go on the day. That's what we're trying to achieve here. And to do this, you need to have a very clear structure of questions that you're going to move through to define some of these things. Essentially, in short, objectively observe what's happened, work out a path of least resistance. That's perhaps the most key thing. Where does your market want to go is a really important question to ask yourself. When I say where does it want to go, where is it going to find it easiest to go? If it starts going up, is it going to find that easy? So you're looking for the area where you can say, right, there's nothing to stop this if we get here. And then asking yourself about access. Where can you get into trades? And we're going to come on to access when we get onto execution routine in a little while. So what you need to be thinking about is clear, consistent questions about each different time frame to enable you to make a clear decision. What this allows you to do as you move down the time frames as well is you take information, and by adding to it, you're balancing the information against each other. We did a bit of this when we looked at mapping on an intraday basis in Profile Week. But by balancing information, you're then able to see this path of least resistance show itself without you just simply going, that's the way I think it's going to go, off we go. You're balancing information against itself. There needs to be specific purposes for each time frame. Don't go looking at every single time frame for the sake of it, for clarity. It's not providing clarity. What it's doing is providing complexity. More complexity, there's more chances of, one, you over-interpreting something or under-interpreting something. And by adding that level of complexity, there's got to be so many things that have got to be right for you to be able to take a trade that on balance of probabilities, you probably won't get that many trades. So don't make it overly complex, but move down through timeframes with clear purpose as to why you're looking at each thing. If you can't define an exact reason to look at it, get rid of it. You don't need it. And then it's about managing expectations. Is there much of an opportunity today? What are your opportunities? There will be some days you look at and you can see that this is quite probably going to be a very balancing, quite quiet day. In which case, it doesn't mean that there's nothing to do. It just means the likelihood of getting lots of trades is relatively small. The likelihood of getting a trade that is going to run and run is relatively small. So playing breakouts is probably not the strategy for you on that day. That's what you're trying to do. Just manage expectations so that you're not looking for something that you're not going to achieve. Because one, psychologically, that's tough, that you think you're going to get something and you don't. That's a bit of a slap in the face. And two, it skews your risk reward over time. If you're looking for a 100-tick move on a day that is unlikely to give you more than 30, all you're doing is creating an expectation and underachieving that, when realistically, you're not underachieving. What you're doing is you're achieving exactly what you should be achieving, but not achieving it in the right way, and having an expectation of what you're trying to achieve, which you're never actually going to achieve. Right then, let's go and work our way through timeframes, why you're looking at certain timeframes, and what you're going to gain from that. Right, let's go and have a look at questioning, moving down through timeframes. The reason to start with this is the point behind questioning and having a clear structure as to what exactly you're trying to find out from each chart that you look at. Now, this is all about not falling into the trap, which all humans do, of answering the obvious question. Take, for example, this chart. This is a pretty easy one. You come in the morning, you look at this, and you go, okay, brilliant. Flag, had a sell-off, market's going down. Right, I'm selling it. That's your trade. Now, that is a trade, and that is a viable opportunity. But if you answer the simple question, which is the way most people go about doing things, they'll walk in and they'll go, aha, flag, where can I sell it? That's the easy question. What you've got to ask yourself is, where's this market really going today? That's a much harder question, because this requires a balancing of information. Is it all that clear that this is going down? What about the way the market fell yesterday? Has that sufficiently moved value? Does it do it on enough volume? No, volume is falling in this instance. Should you be believing this? The flag is created in overnight trade. How does that relate to other flags that may well be created during main sessions and generate a genuine move that you can really believe in? Yeah, how much positioning has been built up in this flag? At what point does this trade actually not become viable? These are the questions you've got to ask yourself. Now, the point of doing that is not to try and diminish the value of this idea. The point of doing that is to make sure that you've covered all bases, so that if we do have a day where actually we start to trade higher, you're not sitting there thinking, I'm going to keep selling this, I'm going to keep selling this, and you just end up losing on an uptrending day. It allows you to then see how it could move higher, what can create a move higher. But also, and bear this in mind, by questioning why that trade will not work, you give yourself the answer as to why it will. If you can't find any strong reasons why this market's going up, why this trade is not a good idea, then you're effectively proving your point that this is a very good idea. We talk about it in psychology, it comes down to, it's effectively confirmation bias. If ever you're looking at an idea and you think this is a good idea, don't ask somebody else if they think it's a good idea. Go and ask them why it's a bad idea, or present the opposite idea and ask them why that's a good idea. Because if they can explain to you very clearly why your idea is bad, then at least it opens your eyes. And if they can't, that confirms that this idea is good. That's the way to try and think about it. What it's trying to do is what you call developing disciplined intuition, which is similar to what a doctor does. Now, I'm sure any of you would have been to the doctors and they ask you some questions which you think, these are blindingly obvious and don't really relate to what I'm here for. Now, the reason for that is to make sure that they've covered all bases. It's not a box ticking exercise to make sure they're not going to get done by compliance. It's to make sure that they're not overlooking anything, which you may well be overlooking. You're not a doctor. Chances are, just from walking in and you explain the very first things, they've immediately decided what's wrong with you. And the point of asking the questions is to ascertain what is actually wrong with you rather than jump to the first conclusion. And if what you say stacks up with what they first thought, absolutely those two things go together. If not, then there is a new line of inquiry. That's the whole point of asking questions, even if the answer seems very obvious. So yes, this is a lovely trade. It's very clear. You can see that you've got break of low. Once you break this high here, that's your kind of line in the sand. That's the danger point on this trade. Once that's gone, absolutely go back, retrace the run up that was created by a Fed comment going into a Fed meeting. So that's the potential of that trade. It all makes sense. So how do you go about doing this? The way you do it, and the way I've always sort of set my days up and other people do it, everyone does slight different variation, but different timeframes have specific reasoning. Starting off with a daily chart. So what I'm going to do is give you an example. This is one of the Euro stocks from a little while back, an example of what you're trying to do with each chart, what you're trying to understand. Start of each day, I don't hold huge value on a daily chart. At the end of the day, you're a day trader. But what a daily chart is there to do, if you don't look at it, you may well miss the fact that you're on a really, really significant point, or direction is very clearly changed. So that's what you're trying to ascertain here. Are we now at a point where you can be very clearly biased one direction or another? So is there a significant change in direction? That's the first thing that you want to try and understand. And this is all about understanding current versus general direction. So what I mean by current direction may well be, taking this example, market is running higher, you then get here that you would have a current downwards direction. So sort of from the most recent swing. General direction, of course, at this point is up. We had a generalized direction down, generalized direction up, and then you have a kind of current direction here. Now, in this situation, what have you got? Well, current direction is nowhere. We are in the middle of a range. You are in the middle of this gap, essentially. So current direction is extremely limited. Overall direction, or general direction, is up. So if you're kind of weighting anything here, what you're just trying to do is just build a picture of generally, if nothing else points in one direction or another, generally you might be leaning up slightly. That's what you're trying to take here. The next thing, I'm going to look at yesterday's candlestick. Now, yesterday's candlestick here is telling me very, very little. There is nothing to be taken from a candlestick shape if it is in the middle of a range. It doesn't tell you a great deal. Candlesticks ultimately confirm a continuation of something or a turning point. Now, this candle is small, relatively directionless, and in the middle of a range. If it's going to show you anything, it's showing you a continuation of no direction. That is it. So we won't take much from that. However, there are candlesticks that you will look at and think, aha, that means something down there. That means something. That all of a sudden is telling you a story. You know, these are the candlesticks that you're interested in. And so they're the ones that create turning points. Apart from that, we don't have a great deal. Here, that looks like a pretty decent candle to turn the market to the upside. Now, on the day, that would have been quite a difficult candle to trade. Market gaps down, trade straight back up. But what that does tell you is that directionally, maybe we're leaning towards the upside. But in this instance, the most recent candle does not change general direction at all. The other things that you're trying to observe, and bear in mind, I'm going to walk this through, and it may seem like this is going to be a lot of questions. These are questions you answer very, very quickly. What's the volume looking like? How's the participation been? Now, you've been trading the previous days, you roughly know this anyway. So a lot of these is just reminding yourself of the obvious stuff that you already know. I'm not saying you've got to have all of this written down, but it's just about making sure that if nothing else, you just have a list of questions and you tick them off as you're going through, mentally going, okay, well, volume is falling. There's not a great deal of participation. You can see that here, volume dropping down. Market is becoming quieter. Think about what the implication of this is. Volume falling will at some point have a very notable change with volume rising. That's going to be a moment that you know is coming. You don't know when, but you know that this is coming. So it's about just keeping a track of the kind of story of what's going on. You expect that you're probably going to have another lower volume day, but you know that if you suddenly see volume picking up and you're seeing higher volume than at 8 a.m. the previous day or at 10 a.m. the previous day, maybe you can start thinking there might be more to this today. Range. The point of looking at range, what I'm not suggesting is you're looking at an ATR, but you're looking at the recent ranges, real range. And so what I've got here on this chart, the blue histogram is the actual range of the day. The gold dotted line is the ATR. And I use a 20 period exponential ATR, keeps it up to the more recent action. So what you can see is recently we've been falling below ATR, smaller ranges, struggling to reach over the ATR. Move above the ATR, suddenly I'm then thinking, right, now we've got more direction. So it's always about, you're asking these questions to understand the implication and to understand what might change. In the absence of change, you assume very similar conditions to what you're already seeing. So there we have, you've got an expectation now that 60 tick range is around about what you could expect. Maybe you might see 80, but that's quite, that's going to be pushing the boundary a little bit. What it helps with is not looking at this going, okay, so we're trading at around about 32.60. Oh yeah, I reckon we can go up here. Well, let's be realistic. That's 500 ticks. That's not going to happen. Even getting up here, you're trading 32.60. That's still going to be an extension of recent range to put in a 100 tick move to get to 33.60. So maybe that's a stretch, but it is just about a viable stretch. So what it helps you do is go, okay, well, if we get up here, that might be a reasonable sell. Equally, to fill the gap is reasonable. to go down here, again, might be a little bit of a stretch. So you're just giving yourself that sense of reality. What can you really expect from it? But on the whole, daily chart is something that you can have a glance at. The main thing that I would be taking from this is we are not at a point where anything major changes. The two turning points for me in this chart are either breaking this high, in which case on a daily perspective, you can now have an upward bias for the next 350 ticks to the recent highs, and equally break this low and trend. Now you can have a downward bias to move through this range for the next roughly 300 ticks to the downside. So that would be your overall kind of, look at it like you would any chart. If you break there, we've got significant upside, break there, we've got significant downside. Until that point, you don't have massively clear direction. Right, so you've looked at your daily. That gives you a rough idea that marginally you'd be leaning towards the upside here. Get onto your profile. What's that telling you? Now, your profile, we're now leaning back onto profile week, and you start with the basic things. What was the day type? So what was the previous day? What we've got is a pretty P-shaped type profile with a week close. So does this match the daily candle? Daily candle, marginally bullish, but on the whole, pretty non-directional. This is a profile then that arguably is leaning towards bearish, particularly with an open below value. So what you're able to ask yourself then is, right, well, who's in control at the moment? And what we've seen is that over the recent few days, so the kind of the mapping out of the story of what's been going on, value has generally stayed down here. Any attempt up, values come straight the way back down, whereas value quite happy down in these areas. So again, value goes up. Who's in control? Well, on the whole, value's still down here. So this would show a bit of sign of strength if they could actually keep the close up there. But sellers have managed to take the market back down. What we're now seeing then is the ability to go, okay, I'm not so convinced by that daily candlestick. I'm perhaps more leaning towards the downside. What this will then help you with is having a rough idea of how the order flow's been. And again, this is going to come from your debrief. That's why we talked about that feedback loop at the beginning. Having a sense as to how the order flow has been in this day. Has it been quite sticky? Has it been quite tough to trade? Where did it become a little bit more free? And certainly one of the freer areas was here. That's where we've fallen into easily at the end of the day. That's where we exploded up from at the beginning of the day. This could be the area where you've got a little bit more sort of freedom of movement, quicker move. Up here, quite stuttered. You can see ledges here, ledges here, coming in at around 75, coming in at around about 86. These two ledges are indicating a market that's not exactly that crisp in the way it moves. So that's what you're trying to take here, right? So who's in control? The next question, of course, then can be very much more of, right, where's direction changing? Lines in the sand. This is developing your hypothesis, or at least developing the early part of it. And we did that just looking at profile during profile week, but now we're going to look at it and bring in the whole lot of it together. So at this point in time, you can look at this and say, okay, well, we're starting with a relatively weak start on the back of a weak close. So the first thing you can look at is value. Inability to get inside value gives a bearish bias, and the point where things really change then is a break of those single prints. That's then where you can look for basically the reversal of that P-shaped liquidation move back down into value, into the middle of this previous range. That lines up quite nicely with the sort of scope of movement as well, that's going to give you to get back down here around about 50 ticks, so there may be a little bit more, but you're staying within the scope of movement. Where does direction change to the upside? Well, getting inside value may well give you a slight bullish bias, but really the ledge, previous high, that's the point where buyers seem to have some control yesterday. They're able to, if they can get above these previous highs, that's where everything looks good, but the ledge implies that they've been pushed back and stopped. So you can then start to build a story, okay, well, if you can get above there, then buyers are retaking control. Now we can start thinking about more towards the upside, and finally a break of the ledge at 86 then offers the ability to go and have a look at this very obvious area of resistance towards the upside at 99, double O zone, and then potentially beyond there. That's then where you get onto your hourly chart. Hourly chart gives you a little bit more detail as to precisely where you're going. The final thing to have a look at as well is just any carried forward references. So what this is all about is areas that still have not finished trading. Arguably, that could be a top. We've gone and traded an area of resistance, we have reacted to it, and they're not massive, but there is a marginal tail. What you have not done is down here, completed this move. So you've got poor lows down there. So in terms of being able to say, okay, if we do see a little bit of change in the way the market's trading, a little bit of a faster move, there is a reference point that is quite clear that can become a target. And that is these 92s down here, which would then lead to a test to the bottom of value, virtual VPOC or virtually the VPOC, and previous high, which comes in at around about 77 to 81. So you can see then where there is a little bit more potential if the market starts to change in the way it's trading. Doesn't have to go there, but the awareness of this does mean that you're now starting to see how you could get that larger move. You're bringing that into your kind of scope of possibilities. So that tells the story from profile. Roughly, we're now going against the generalized move on the daily and yesterday's daily candle, and so looking at this thing, well, arguably, it's going to be harder to go up at the moment, and we need more things to change to give a bullish bias than we do bearish. We're starting off marginally bearish. Without something changing, it remains reasonably bearish. So next up, 60-minute chart. What a 60-minute chart is there to do is to pinpoint areas that are reasonable. Areas that you genuinely might be able to get to if a move develops, and areas where you can say, yep, now things are starting to change. So we know the rough ranges at the moment. 60, 65 ticks is around about what you're expecting. The ATRs at about 85, so between 60 and 80 is acceptable. So then you can start going, okay, well, if we do get a move towards the upside, what have I got? We're starting off at around about 32.60. Yep, that high seems reasonably acceptable, 33.24. And these recent highs, which is also a gap, 33.64, is probably the limit of expectations for how far you could go on the day. Downside. So let's look at 60 ticks from here is going to take you roughly to down here, to 3200, which is just above those poor lows at 31.92. And then beyond that, again, you've got another gap down here, which is 31.51. They are realistically your kind of limits of expectation. I'm not taking loads and loads of levels from an hourly chart. I just want to be able to go, okay, these are significant points that can be targets, can be reached if we start to get a move that has the energy in it, the volume in it, the change of flow in it from what we've recently been seeing. Otherwise, we could well be stuck in areas that we have already previously traded. The next bit is structure. You can see a lot from a profile, but structure is very clear when you look at an hourly chart. So what have we got? Well, if you look at the story of what's happened here, we've had a market that gaps down, trades down, gaps down again, a strong reversal. Yes, volume's not great on the reversal, but it has put in a strong reversal and then confirmed that with a gap up that has continued on. So whilst, yes, volume's not wonderful on it, the action that it has put in makes this still reasonably strong. So gap up, market trades higher, and we sit in this kind of sideways range, which essentially becomes a bit of a channel. So this range here, from 52 to 92, is the way I look at this is your base. I sort of look at trades like this as a move that's going to step. Think of it as a long-term trend to do something along those lines. So you're just going to step higher. So you've got this base of support. Now, as long as we stay above that, market looks reasonably strong. This could well be the beginning of the next step towards the upside. This then suggests that break of that ledge gives you this potential move. So then you're taking the profile and saying, right, get over the ledge, I can lean to a bullish bias. Get over the ledge, that high is reasonable. If you can break the channel, this high is reasonable. So you're now forming targets as well. You know, what's going to get in the way here? If you break that high at 33.00, there's very little to get in the way. That will break these highs. There's nothing to stop you going to 33.24. So you're seeing the potential of move. You're looking at, right, where's the open space to move into? So ask yourself about hurdles. What's getting in the way of any kind of movement? Where have you got open space? Where are you going to find it sticky? Where are you going to find it easy to trade through? Downside, if you get the right type of trade, pace changing from what you've seen recently, this, as we know, is a wide traded range on light volume. So we could well see a sweep through that range, which now makes that 31.92 poor low a much more enticing and viable trade, certainly if you can get below 32.52. So it now opens your eyes to the real potential of this. If we can't get out of the range and stay out, this is now the chance for a turn, because everybody who's been getting long in here is looking at this to do that. If it doesn't happen, that's where you could get that extra pace coming into the market. Of course, you don't know if that's going to happen. If you don't get below 32.52, it's not going to happen. But you're now starting to see, okay, there's perhaps more to this than just simply going, well, it's reasonably quiet, might be just a steady move into this range and that's it. So that's the whole idea behind an hourly chart. Giving yourself clear, sort of significant levels of interest that you want to be looking towards. If you can get in certain areas, then you say, right, there's nothing to stop me here, I've got space. It helps with those trades that you're in and you're looking at thinking, oh, this could take a while, it's going to be a bit of a slow, a bit of a steady move. They're tough. But if you've done this, then you go, okay, but I know where it's going. I know where this can potentially go. Again, that line of least resistance. You've got that, you go, yep, this is it. This is going to work. Let the trade do its thing. What you then need to be thinking about is trading conditions. Now, you will know how the market is traded in here. You will know how the market is traded when it does put in the up moves like this one, this one, this one. Yeah, how is it trading when it goes up? Because that's then going to help you go, okay, well, that's the kind of thing I'm looking for. Get something similar to some of these moves, which all incidentally have come relatively early in the day. Start seeing that again, even this one. Now you can think, yep, I'm going to go for this because it looks right. So a little bit more detail then on how the market's trading, what exactly it is doing. And you're going to get that for a 5-minute chart. Now, I would rarely go below 5 minutes and get onto 1-minute charts, or indeed footprints. I'm not going to be bringing in a footprint within my daily prep. Where I would bring in a footprint is to be specific. Once I've identified areas that I'm interested in, to then go, okay, now I'm going to get a footprint and look precisely at what happened perhaps in here, in here. You're looking for that little detail that will give you that turning point. Perhaps there was some absorption that happened over here and then came back here and came back here, and that's what stopped the move. Particularly on this ledge, that's where you're going to have some interest. So it's those little levels of detail. So with a footprint, it's not part of my morning prep. It's more part of once I've decided where I want to trade and what I want to do, then I'll bring the footprint in to go, okay, well, let's just have a look at the detail of how it looked last time. Particularly if you can't remember what it traded like specifically when it was trading there. Perhaps this is a ledge created after you finished trading for the day. You know, what exactly was happening, because then you can understand what's got to change for the trade to be viable. So what your 5-minute is going to help you do is become precise on where you want to trade, and this will come into execution routine in a bit, what I call immediate versus delayed access trades, and I'll explain those in a little while. But by having precise execution zones, you know that you don't need to be getting involved up here, seeing what might happen, maybe getting short, maybe getting long, it might work, it might not. You don't need to do that. If you're precise on where you want to be in, you can then say to yourself, right, get down here, now I'm interested. Once we get down to this 32.54 zone, now I've got some interest. That low from yesterday, 32.52, was done right in the very final minutes on very low volume. So 54 is the area that has been quite significant, 57 to 54. Incidentally. So that's the first area. You've also got this liquidation move. So now you can also look at this and say, well, we've got quite a comfortable 10 ticks here. So now you're getting a little bit more detail. Now you know that if we break 54, 10 ticks is going to get you through this liquidation. And this is the bit where you're going to find out whether this has got more legs to the downside, whether there is any more selling, or whether this is just merely a drop into a liquidation area, and that is it. So you now know what you're looking for in here. This is going to tell you whether the move has got some more legs in it or not. If it's going to fail to the downside, probably going to do it here and do that. Once you're beyond that, then you're looking at, right, well, where else might be sticky? What I mean by a sticky point is a level that you could say, okay, it might not find it too easy to get through there, or it's not super clear where precisely the level is. This zone down here, for a 5-minute chart, you see that we've found resistance, then it's support, support, resistance, then it trades through the area, resistance, resistance, trades through the area, support, support. There's a slightly sticky area. This runs for about 22, 2027. That's where we could find it a little bit difficult. And then beyond that, if you can get through these lows, which come in at 02, then you've got the 92 bad low to be targeting. So this kind of becomes an area of interest that if you get through that, now it really does open up, because now it's showing you that it is willing to go through the range. So that's now told you, right, you know what you're doing to the downside. This is an area where things could change, and if you get through there, down here, get through there, there's nothing stopping you now to get to 92. So you're seeing where the market can become a bit more free, where it can accelerate. Upside, what have you got there? Well, you're looking at the details here. That ledge at 75, which is also a previous high, and then the other ledge up at 85-ish as well. So 75 and 85, I said 86 previously. 75 and 85, get through the first ledge, get through the second ledge. As we saw from the hourly, there is nothing to stop you now. Get through those two, we're off and away. 33.24, oops, is where you're next going. So it becomes very, very clear. To add little bits of detail to this is then where you bring in things like delta, footprint. So I'm not going to be having a standardized look at these things. What I'm doing is having a standardized look of being able to say, okay, this is where we can go. This is who's in control. So it's about looking at your map. Then you're going to be looking at the detail, which is going to change each day by considering what the delta is looking like. And what we saw from delta on this day is that all the buyers weren't willing to hold on to this because they all got rushed out at the close. So you got a lot of buying. This is Euro stocks, about 15,000 worth of buying. Euro stocks is usually limited, 20 to 30,000 is about the limit of delta you might see on a day. So this runs up near a high delta day and then just gets turned over at the close. So what that's saying to you is that buyers aren't really willing to hold on to this for the duration of the day or at least overnight. And then you bring in the footprint as well, like I said, to find the details on some of these little areas. So these are the things that are always going to change, and you're looking to see how this relates to what you're seeing up here. This way, you've now gone through all the information. You can start to develop your hypotheses of what exactly could go on. So it can then be reasonably clear. And it's all about giving yourself a clear map of what you can do on the day. This slows you down, which is a good thing, not a bad thing. This means that you don't need to be trying to get involved in every little setup and every little opportunity that you may see along the way, because there will be lots on the day. You know where you're interested in. You know what the scope of this move is. So you don't need to be involved in the other stuff. Leave that to other people who maybe are looking at different things to you. But from your own point of view, you know what you want to do. You develop your own hypotheses of what can happen. So first up, you've got the orange idea that once you're through these single prints, that's that little liquidation zone here, liquidation of the longs drops down into that kind of sticky zone around 27 to 24 onto the previous VPOC and stops. That could be it. Relatively small day, just another balancing type day. That's one thing. Upside, get inside value, we're looking good. Then you've got the ledge to break. So you've got the two ledges at 75 and 85. This could be an area where we're not sure. Once you break the 85 ledge, then you can look for a bit more trend into this. Make sure you've got your lines in the sand on these. Where is this idea a no-go? Where can you say, right, not doing that one anymore, moving on from it. And then finally, you've got the red. It's a little bit clearer to the downside than the upside, perhaps. The upside kind of everything falls into the same thing. It's really get inside value, and this could well be just a muted kind of normal day, or get inside value, show some change in the way we've been trading, that buyers actually, rather than just bump the market early in the day, as we saw from that hourly chart, actually bump it and then start to run again, put in a trend looking day, crucially above 86, then there's more to this. Downside, you can see the early liquidation to give yourself an early clue and a chance, and then it's about this sticky zone. Down there, if you break that, as I said before, then you do have the chance for the move down towards sort of 31.92, and that then gives you that bigger break towards the downside potentially. So you're now very clear on what you want to do, you know exactly where the opportunities lie, and you know that when you get into a trade, you can expect it to go here or here or here. That's the whole point of routing. It's the consistency of asking questions means that you can come to these conclusions relatively quickly. So just having that list of questions, you don't have to answer every single question. It's not about writing down the answer to everything. It's just about going, right, have I made sure that I've checked these pieces of information? And if you've done that, you can be confident that the conclusions you draw and the ideas that you have on the day are genuine, legitimate ideas that you can then go and trade. Of course, they can be improved as time goes by, and that's the whole point of a debrief, which we're going to get onto. So, the result. Remember, aside from the trading of it and your P&L and your performance, this is ultimately testing your hypothesis. If the result is nothing like anything you thought, well, clearly this tells you that something in your prep can be improved. Your judgment of some of the information is off, and you can then go and look at, right, well, what bits of it were right, what bits of it were off, and start to then improve and adapt and work out other things that you may need to know. So what we have then is a day that fails to get inside value. That's your first bit of info. So that would lean you towards the hypothesis of a move lower. Then you do get the liquidation through 52. Remember, 52 was that key support area. We get the quick move down. We drop, in fact, below 45. So that really confirms the willingness to go down and hold down here. So having seen that happen, now you can think, right, I know where this is going. At least we're going to get a move down towards the VPOC. So you know now in this zone here that you've got at least another perhaps 20 ticks to go on this move, and it goes down there, little overextension beyond the VPOC, and then we come back up into this sticky zone. So that is 20 to 27 in here, and that's what this zone is as well. And you could see that from the 5 minute previously, that's where the market kept going one side then the other, and occasionally got stuck. So this is exactly where you expect it to become tricky in terms of direction. So if you're not a sort of range trader, someone who wants to sit and scalp a small range, this is the area where you're looking at that going, right, let's hold back and let's wait to find out, is this going to be early drop balance, or is this going to exit the range to the downside, in which case there might be a bit more. Now when it does drop out of the range to the downside, you've already got that bit more, because you know that 92 is potentially the area that's going to allow a release, because they're the bad lows. So now, once you fall out of this range below 17, you can start thinking about, right, how can I get into a trade that allows me to be short for the break of 92? We found this small range previously, which runs from around about 03 up to 14, breaks that, trades down to 92, breaks 92, and then you get the liquidation into the close. Remember what Delta did the previous day? Big drop into the close. What does Delta do here? Minus 40,000 into the close. So the one thing that is a repeat of the previous day is the big Delta drop into the close. This one much more extreme, because rather than this being a reversal of some buying on the day, this has been relatively flat Delta, and then you get selling really coming in from a zero Delta, and that takes us down to minus 40,000. So very extreme in terms of the move. So this then helps you, okay, so the hypothesis was good. The specifics, your hypothesis is not there to go specifically it's going to trade here, then here, then here, then here. It's not trying to build a sequence. But on the whole, you can say, yep, this does stick roughly to what I was thinking, that you get down, we then find out if it's two directional or not. When it is not, clearly there's another leg. So this is only viable if it proves that it's not just going to balance out. At this point, you're thinking, well, you're going to have a profile that looks a bit like that. Once we start to fall out of this zone, now you start thinking, okay, we've got more. This could be a bit more of a trendy type day. So there you go. It tests your hypothesis, which means that now you can go back and improve your hypothesis, which also means that now tomorrow's preparation is going to be much easier, because you know exactly what happened here. You know where the resistance came in towards the end of the day, back at 92. You know where the volume comes in here. You know where the strength from the sellers was. You know that the sellers managed to maintain control all the way to the end of the day. It becomes clear what the market wants to be doing. So there we go. That is your technical preparation. What we're next going to move on to is the news side of things, because that's something that we've not talked about yet, but is crucial to all preparation. So news coming up.